So what's included in forgiveness? Payroll excluding federal employer taxes. So the component of the loan that can be forgiven has to be greater than or equal to 60% of the loan. So you can't spend any more than 60% or less than 60% on payroll. That will reduce, for example, if you spent 50% on payroll and you had let's say you had a $100,000 loan, you spent $50,000 on payroll, your portion of the 40% that made up rent, utilities, and mortgage interest would be limited to that $50,000 component. So the $50,000 would be the maximum component on the payroll in that particular case, and then you would get basically the additional portion of that to pay, which is about 2/3 of it. So you would be reduced down to about 45,000 in that particular, I'm sorry, 40,000 in that particular case. So what's included? Wages, bonuses, commissions, hazard pay, severance, basically cash compensation for employees, and some for the owners if you qualify. Benefits, employer paid benefits, not the employee paid benefits, so you don't get to count money that the employees pay in. And the big kicker here for the restaurant industry is tips, because tips count towards cash compensation for the PPP. That is a very valuable thing because it essentially more than offsets the federal employer taxes, and you get credit for those tips towards cash compensation. Yet you don't have to count those tips towards the cash compensation minimum for making sure that there is no wage reduction. So being able to count the tips in has been a very valuable thing, and there's been a little bit of clarity around that. So I'm hopeful that whatever has been ruled at this point sticks. So rent, and that includes not just traditional rent, but rents on other things, such as your dish machine and other things that you pay rent on. Utilities, make sure you get those utility bills in, because sometimes they can drag 2 or 3 months. So we want to make sure that we get those in the coverage period. And then mortgage interest. And your loan documents really show the collateralization, whether they still qualify. So things that you have loans on that you're paying interest on, that secure assets, are really what you're after. Not just your traditional, mortgage on a building, but things that you pay interest on that secure assets. For example, a fixed asset, or perhaps you opened a restaurant a couple of years ago and you're able to use that equipment. You've got a loan against it. You're able to write that interest off. Include that.